Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Thursday, May 8th, 2025. It is 2:53 p.m. Eastern Time. And what I'll do on this one, I believe I did this yesterday, we'll just update the markets and the metals. That's gold, silver, GDX, and the equity markets. I'm going to start out. Today was a quiet day. I've been just in and out of my desk. There's just markets gone nowhere in a week. And I want to talk about that a little bit. There was quite a few comments today, and I just want to share my thoughts and my replies here, kind of sum up what's going on in the market. So, what is this one? It tagged whatever, 19% bounce. Are we sure that stock is? This has to do with Carvana. And so my reply on that is, what I always say. I've said for years, personally, I don't trade on fundamentals or anything else. I do factor them in, and I made mention on there. I think in sometime in 2025, I've read a lot about this stock in the past, and is my belief, not as an expert, it will come out that they have shady accounting. Has to do with the prices they claim and the profit margins on each car compared to other dealerships and everything. I've been in subreddits on that. But again, that's fundamental, and I don't trade off fundamentals. I trade off the chart. So it is a trade, and like any trade, I say take it, don't take it. I've never encouraged it. This is not a collective trading site. We're not long anything. We're not short anything. I share trade ideas, and I don't mean this in any way to be offensive, but pass on the ones that don't mesh with your trading, with your outlook, number one, for that security. By all means, if you think a stock or the market's going to go down instead of up or up instead of down, you see it that way, no reason to take that. Or if it doesn't mesh with your risk tolerance, Carvana is a rocket and trading style. And what I said on Carvana, and I also said this, somebody asked about Palantir, whatever, PLTR, that they both, Carvana and that one, are just pure risk-on stocks. I've followed them for a while. You can overlay the charts. It's like trading QQQ with jet packs on it. In other words, they're just going to go up and down with the market. They're complete risk-on, risk-off stocks. That's how they've typically traded. So Carvana, we had that opportunity. You got to watch if you're going to take it into earnings, which I said I was doing, and threw it out there as you got to take advantage of those hits. A 10% drop. It was actually 12% drop into T1 in the after-hour session, especially on a big earnings beat. So that's just, again, it's the we usually get a reaction on the initial tag of a target. It's a big bounce, but it's really not so big at all relative. Again, I use the word relative a lot, and you really, really need to factor that word into trading. It's everything is relative. Carvana is moves 20% easily in a range post earnings, and that's just that stock. So again, take it, don't take it. And it's also, I wanted to add that one will most likely, if QQQ goes on to take out the 500 level by a fair margin, starts moving higher, that's when that trade, at least my own trading plan that I've shared, that's when I start scaling out of QQQ shorts. Then Carvana's probably going to go higher as well. And if QQQ stops here or anywhere around in my bounce target zone, which I still think it will, Carvana will go down. That's why I highlighted Carvana being up so big earlier today as an objective short entry. And where was it then? It was at, I'm going to move this over here, screenshot, 282.70. Let's see, I haven't even looked at it since CVNA. 282.70 and 290.29. So it's up a little bit there, and it is back above that trend line. So as I said, the more conventional, conservative short entry is on a break of that trend line. Let me change my tool color, and so that's what that'll be. And you still have on the 60-minute chart the negative divergence as well. So there's that little wedge, and that's it. So I don't want to spend too much more time. That's just one single trade, as is the market. Remember, the market's not shouldn't be an entire position in anyone's portfolio. There's PLTR, and so the same thing. There's the reply. I just corrected. PLTR didn't jump on earnings; it actually dropped. Remember, that was a post earnings drop. It was posted as a setup, and before earnings, and then we broke the trend line. And so it's sold off hard despite a post-quarter blowout that blew away expectations. As with Carvana, PLTR is a risk-on stock that trades like QQQ, only on leverage, bigger rallies and bigger drops. The stock is rallying in sympathy with the risk-on Nasdaq 100 today, but it remains solidly below the uptrend line. There's the chart I posted. Again, you can see these in the comment section. So that's it. There's this sell signal breakdown following a divergent high, kickback rally. It can go up and back test. You're going to have to decide where your stop is. If you're targeting T3, again, you use at least a 2-to-1 RR is my preference. Depends on the trade. Sometimes I'll use a 3-to-1 or even a 5 or 6-to-1 RR, or even better at times. It all depends on the trade. So, so those are all the targets. Obviously, the dashed line is potential. This is my preferred current target. Takes it back to the 200-day moving averages and that T3 level. And again, this is nothing but a snapback rally. And you know, I try to get away from the word promise and guarantee and all that. That was a dirty word when I was, you know, in the business as a financial advisor, stockbroker. About the only thing I could guarantee you was a safe investment was a treasury bond. And even then, the government can, you know, technically default on treasuries. They'll be doing that going forward by printing money to pay off existing treasuries. There's no way out of the debt the debt situation this country's in. But again, you'll get money back. It's just going to be depreciated dollars as they print more to issue new treasuries, and that's how they get around by not defaulting, a hard default where they stop making payments. But again, that's longer term. So so we need longs, not shorts. Okay, where's my reply to that? And guys, this is if you followed me for a while, this is my trading style. Nobody, and we can go back and check. Maybe I'm wrong. I'll miss a comment or two. A month ago today, literally it was, what was it, the 7th, yesterday. A month ago yesterday, that's when the market bottomed, and we were still in that extremely volatile period. Nobody here was asking for longs a month ago. In fact, I believe there were more requests for shorts. Should I short here? And that was the tail end of the biggest drop in years, and that's when, and now in reverse, I was covering shorts, adamant and persistent. No longer objective. Time to start reining in, harvesting scale out of those shorts and start going into longs. And then I was adding long trade ideas, not short trade ideas back then. So again, there's plenty, 99% of investors out there, institutional individuals, and I'm sure if you follow other investment sites giving you trade ideas, they're going to throw out mostly long trade ideas. I'm kind of a niche, you know, throw out a lot of shorts when I think the time is there. And that's what you were getting back then, long trade ideas. Most probably didn't want to take them because, again, everybody thought that the sky was falling. It was a penny henny situation back then. And, you know, for all the reasons that have then materialized, I about the only guarantee, one of the few I gave you back then was they would reverse on Trump would cow down and reverse. There would be forward progress made, that they would not have these ridiculous 150% tariffs and everything for much longer, and that it couldn't. And then I said, look, I acknowledge anything's possible. But I said the market, the whole entire financial system would break. They're at the point, based on the charts, based on what I was looking at, knowing what I've known, trading through crashes before in bear markets, we were hitting the red line on the tachometer there, where if the market continued much lower for much longer, things would start breaking and blowing up in the financial system. So that was the fundamental reason, which I do factor fundamentals in my trading. But technically we hit, let's not forget, we hit T3 on QQQ. And this is just all one big long-term trade. And I see no reason why I should deviate from the trading plan, the longer-term trading plan, which is down here. So we had a big drop back there. It's all part of this call for a major bear market back here. But when we hit T2, the morning of August 5th lows, also back then, that was an immediate hard reversal the morning of, because we hit also additional targets on my futures, NQ futures. And so that was a cover all shorts, go hard long moment. And so this is just the next, we had a bounce, went a little longer and a little bit further than I expected, down to the T3. Remember, SPY also hit a comparable T3 right there to the button that day. And this was that expected bounce right into the target range. So what I'm trying to do here is just reiterate that nothing's changed. And like any trade, this is the most important thing. It either pans out or not. You know where my stop scale out zone is. It's not a hard level, just like I've been scaling back in because my degree of uncertainty was a lot more precise here to get back in after we gained that bounce with the 200s. Here it's been more of a wider, fuzzier range, and we're at the top of that range. And as I told you in recent videos, even though the range technically goes up to about 500, like I said, I don't care if we take out the 200s, it wouldn't surprise me in the least. In fact, if I had to flip a coin today, I'd put 50-50 odds that we'd probably pop it and blow out some stops. And if we do, that'll be probably a big green candle. But again, you have just a mountain of resistance overhead. And then on that, let me go back to my comments here. There's another one I wanted to make about, yeah, so that's the trading plan, and nothing's changed, and it's not, it's one trade. It's not, even though the market technically has hundreds, if not thousands of stocks, depending on what index you're trading, it's one single trade. We also have the scale back zone into VIXY, and that's it. So just like if you go back a month ago today and you watch the videos, and I was highlighting trade ideas, bounces on things like Bitcoin and Ethereum and the stock market and QQQ and all the big Mag 8s and all that stuff. And now it's time to, in my opinion, shift and go the other way. It's that in reverse. However, so let's see, triggered up. Oh yeah. Okay. So this is about the fourth or fifth time I've heard here about the breath thrust triggering. Oh, it's only triggered 20 times since World War II. Look, that's great, guys. If you have something that you like, stick with it. Go long and buy that breath thrust. But I don't follow any. I look at and I'm very familiar with that. It's been around forever, and I've heard of it. And I just do my own thing, kind of in a vacuum. But so if you want to follow that, great. Now here's the thing. So the breath thrust, it only triggered 20 times. Again, I'm not verifying this is correct. It sounds right to me. And it triggered this past Tuesday. Might be worth looking into. Again, third or fourth time somebody's mentioned it here. So my reply, triggered last Tuesday, laugh out loud. QQQ, and I checked it, closed up 18% above its April 7th low last Tuesday. And if that's what you meant, Tuesday before last, I'm sorry. And if you meant this Tuesday that just passed, it's closed up 20% above. All right. Had I waited to cover my shorts and go long, which I was doing back then, I would be up literally since that signal triggered a whopping 2 to 3% on QQQ right now. Again, from either last Tuesday or the one before, the week before. Not to mention the massive profit give back on my shorts. So so sorry, but I'm sticking with my trading plan, which almost always involves positioning well before the mainstream buy and sell indicators trigger signals. All right, so that's just me. Again, you do you. If you think you should go long based on that signal, great. I went long a month ago, and I'm closing those longs out one by one on a kind of a decreasing thing. There's not many left now. Besides, the indexes are only one of many trades. And then note this. Note how SPY and QQQ haven't gone anywhere for the past week. So while I'm not seeing a lot of new attractive trading ops this week, you can see I've cut back on posts and trading ops. I'm just not seeing a lot of good stuff. If you're coming here for quantity, if that's your view of a good service, someone that's going to give you 5, 6 trade ideas each day and every day, I promise you're at the wrong place. I've done this a long time. I make my money in spurts. When there's not a lot, I don't force it. I always say you can't squeeze water from a rock or blood from a stone. Same thing in the stock market. You can't go in on any given day. There's just times I look around and, there's just not a lot right now, new attractive trading ops that are exciting me, other than scaling back into, the long-term trades. But active trading ops, it's, Fed week, like I told you. I just stand aside. It's going to get chopped into pieces. Whipsaws are common during Fed weeks. So that's that. So, and I'll continue when I see them. And you guys know I'm constantly putting out, hit and run trades, what I call them, on various commodities, crude oil, natural gas, individual stocks, treasury bonds. You get in here, get out. These are swing trades, typical swing trades lasting a few days to a few weeks. We've had plenty of those lately, a lot more hits than misses in trading the things like crude oil and natural gas. I'll get to gold in a second. So that's that. And again, to reiterate, I've shared in recent videos, my trading plan right now is to scale up to, which we hit today, and I'll get to the charts in a second, up to, but not any higher than the 200-day simple moving average. Even though that's a little below the top of my scaling zone, that's just my plan. And I want to now wait, as I showed you yesterday, I want to see those uptrend lines taken out that I highlighted in yesterday's video. Those are the uptrend lines. They're very clear, well-defined on SPY, QQQ, many of the MAG's 7 or 8 stocks, as well as the market, the main largest indexes, I'm sorry, the largest sectors in the S&P 500. Again, I believe that was yesterday's video. So what do we have here? One more. A little pump here. That's fine, but this is not a balls of seals trade. Again, I'm assuming that comment that love how you're sticking to your guns. No, what I'm doing is, guys, this is paramount to trading 101. You have a trading plan, stick to it. I'm a very flexible trader. If I see a reason, if I sniff something out that I didn't see before, something doesn't feel right, sure, I'm not a pure mechanical trader. I will modify or pull the plug on a trading plan. But it takes, I need to see something. Right now, I haven't seen anything that would convince me to change the trading plan for the long-term swing and trend shorts on the Nasdaq 100. So my reply is, I think I see what you're saying, and I'm assuming you're referring to the Nasdaq 100 trade. It's really not a complicated trading plan, nor is it one that requires nerves of steel or a big potential loss if it doesn't pan out. It was a simple scale in this relatively small shorting zone. Again, relative, because the upside above the shorting zone is going to be a few percentage points, probably not more than 5-6 percentage points, compared to the drop, which is measured in high double digits if the final target T7 is hit on QQQ. So the RR is extremely favorable, and that's a very small window. Again, if you're looking at it from the perspective of the bigger picture, that longer term trade. So that's it. It's a simple plan. Scale in that zone. I'll get to it in a second. Or start scaling out if QQQ starts to punch above 500 and it's anything but a brief pop. And again, it's an incremental thing. I've explained that why, and I'll do that again when I get to the charts. So I went on to say, with the comments that I've seen today and this post and others, you would think the market was up 10%. And in the past week, QQQ is up a whopping 1.59% since last Thursday's close. As I typed this, I replied at 251, and still trading below the 200-day simple moving average. Guys, I don't get it. This is what I talk about every day. It's like the markets are below their 200s, and you would think that we just broke out the new highs and we're up 30% in the last week. Again, the bulk of the move off the recent lows, we captured. We were long, or at least that was the positioning that I had and was recommending here or suggesting on the site. So anyway, bull spirits are running hot right now for sure. But just like today, right now, it feels like, and again, I'm just basing off, maybe it's a handful of comments, but it's just like in reverse. 1 month ago today, and if you look at it, turn on the NBC Nightly News, watch the parodies on Saturday Night Live, and just everything that was out there, and just talking to people. I mean, you get phone calls. People thought the world was coming to an end 1 month ago today, and now all of a sudden it's like we're in some 1999 style supercharged bull market, and we're still well off the highs. In fact, we're still below the 200-day moving averages, so that's that. All right, guys, so you got just to give me my head, like, things may change, and that's it. Someone either pans out or it doesn't. So let me get to the charts again, especially for those who are new. So here it is in a nutshell, not to spend too much time on it. Bounce target zone. There's the 200-day simple moving average right here. We hit it the other day. We hit it again. We hit it here. We bought it there long. We fell to it. The last bear market, I've covered this all the time. We bounced up there. We hit the 200 simple right there and there. Hit it again there. This time we made it halfway between the exponential and simple. And this time we hit the 200 simple again. So it's very simple to me. We take that out. if it's taken out on a solid daily closing basis, especially on a solid weekly closing basis. And what I mean by solid, I mean you don't have to squint to look and see if you're above it. When you're clearly above it, that will be nothing but a net bullish event. Now, it could break out and then fail. So we put a big green candle like this, and maybe 1 or 2 days or no days later, and we fall back down below, then that won't be bullish anymore. See, the markets are dynamic, and so is my analysis. It will be bullish if and unless it fails. So that's it. So breakout above that. That's why in my plan, even though I could see easily the Q is going up, and that's why my bounce target zone's a little higher. I can easily see that. Again, I laid this out before we even got to the 200s. I laid out the bounce target zone before we were even there. So we're there now, and that's it. So again, that's it. So we start going up, and I like to do same way when my visibility or confidence in exactly where we're going to pivot isn't high. That's where I give you zones, and the zones are going to be wider as a reflection of my confidence being a little not as clear. In other words, again, it's based on technicals. So that's it. And so that's it. This is where that trade starts to go wrong. And then, as I said in that those comment sections and in the video yesterday, so now I will no longer add, even though I can see us going up to 500. It's not going to change anything technically. Again, it will change it by the fact we take out the 200s. I don't want to. I'd rather wait, see the 200s get popped, and then fail, just like they did back in previous bear markets, and it's very common. Then I'd rather short the failure of a failed breakout versus shorting the breakout itself, right? Does that make sense? All right, so there's my plan. You got it. It's pretty solid, and hey, it's one trade. It either works or it doesn't work. The S&P 500, just update that. Turn off all the lines here real quick just so we can see. That one, you can see it popped the 200s by a single day right there, held above it, very small doji, and then the next day it failed. And that's when the masses see that it's become clear to them that both the Nasdaq 100 and the S&P 500 on a bear market, when you're below them, you get rejected. Tried to rally up, then it hit the 200 simple right there. I'm sorry, exponential, and then rallied down. So that's it. That's where we're at, guys, technically. And like I said, the QQQ is more of a risk on index than the S&P 500 because the S&P 500, although it does have the same top big tech high growth company risk on stocks, the Mag 8, it is also, unlike the Nasdaq 100, chock full of defensive issues. It has a lot of consumer staples, a lot of utilities, things which tend to go up or at least go down less in a bear market. So QQQ is more of a risk on index. And so then those risk on stocks like Carvana, like PLTR, they're going to go up more on a good day in the Nasdaq 100, just like they're going to fall more in a down day. And so that's that. And so that's kind of the basis of those trades too, is why I'm still sticking with those. All right, let's move on to gold. Gold still above the recent island cluster top and bearish engulfing candles. And what you might notice today, see this candlestick? Other than the bearish engulfing put in the high, that's the biggest red candle we've had in months right there. Again, I say this often. If you think that is mere coincidence that the U.S. dollar or UUP, the U.S. dollar ETF, is having its biggest day, biggest green candle in a while, about the same time last time we had that big a candle in the gold, then you and I can disagree. So I laid this out. The gold trade is going to require a little patience. That I made the bullish case to be long the dollar, that the dollar is most likely bottomed, at least a near-term bottom, hitting long-term support on my weekly chart right here. That purple box coming down through there, just like it punched through briefly right here. And that did establish that spike down, establish that previous reaction low back into it. And so I said this would most likely build, it would be at first, most people, some pros, a lot of people do understand the relationship between the dollar and gold. I can assure you that the vast majority of the general public, i.e. dumb money, doesn't. And so what happens, I said it would take a while, and the more we start to go up, the more this proves to play out. If we continue to see more upside to my additional targets, this is what I said a couple weeks ago, gold would start to get the memo. And I believe in the last update I gave you about 2 weeks ago, I said when we take out my 2756 target, it should be a swift move up to the next one there, 2778. These levels haven't changed. And as we continue to move up, more and more folks would start to quote unquote get the memo that the dollar's rallying now, and that is net bearish for gold. Again, if you're new to the site, I say it often, it's very simple. If you freeze supply and demand in a vacuum, all other things being equal, a rising dollar is bearish for gold, and a falling dollar is bullish for gold, because when the dollar's dropping, it takes more dollars to buy 1 ounce of gold. So gold gets more expensive, right? And when the dollar goes up, it takes fewer dollars. So that's the reason for that. That's an immutable mathematic fact if you're trading gold in the US dollar. Again, the tough part comes in. There are periods. They're unusual, but there are over time periods of disconnect where the dollar and gold are not moving inversely. They're moving positively correlated due to overwhelming demand for gold, which we saw in the last few months, or overwhelming selling in gold that can offset that relationship. So please understand that. That's now, again, so all of the things being equal, this is helping gold. And again, it is not mere coincidence that today, ECB sat tight. And again, if you think that was random, it's all this stuff's priced in the charts. I always say that the fundamental news headlines will often, they are related. They're very much related. But, Powell sat tight the other day as expected. And then the Bank of England decided to cut again. And so what that does, it drops. And that's not even a big one. It's the smallest, one of the smallest ones, or I shouldn't say one of the smallest, but it doesn't even hardly move the needle on the dollar. The euro is a much bigger component of the US dollar, and the biggest, and then the yen's the second largest, and the pound's in there, but a smaller weighting. Either way, it doesn't matter, right? What all that matters today is that UUP is up and still moving up that long-term support, with gold having one of its biggest down days in a while. I'm not in love with this trade. There has been just like lately on the stock market, there's been a resilient bid for gold. They've been buying the dips. So it's just like the stock market. I think I meant to show you this a minute ago. I talked about the quotes, but this is what I was talking about. This is last Thursday's candle right here. We've gone nowhere for a week. So that shows momentum is waning right now in the stock market. Now you can look at it as glass half full and say that's bullish, that the sellers just aren't here and the buyers are buying every dip. Or you can look at it glass half empty, saying the buyers are running out of steam, we're running out of buyers. All I can tell you definitively is there's a trading range you can recognize and see there, and a solid upside break, as long as it's not a false breakout, should be bullish and could determine the next trend up, or a downside break. And a downside break's also going to mesh with a break of my uptrend line there, and that would be bearish. But that's what we have here, is a market that's going sideways. So again, when there were quite a few, what I thought the overly bullish comments today, and market's gone nowhere for a week, but up about less than 2%. So back to gold, and that's it. So, longer term, we still have what appears to be a blow off top. It is, little atypical. Usually you get a blow off top. Once a reversal comes, you usually start falling hard. And when I look at the daily chart, the only thing that can make this better, let me find a clean board here for you. The only thing that would actually give you a better setup, you know me, I love my divergent highs and divergent lows. They are not the be all end all. Sometimes you get a divergent high and you don't get a reversal, sometimes or a divergent low, but quite often you do. They're good trend indicators, to signal an impending trend change. But you can see if we can get one marginal thrust up, and again, it has to be marginal, and then you want to see a reversal. You can see here on the daily, you'd have some really nice negative divergence. That's one thing on the daily you didn't have right here on that potential top. That was a candlestick topping pattern, the island cluster top and the bearish engulfing candle. So now we may or may not get that. The dollar, as I showed you, may have put in a bottom. There's a lot of evidence it's that, and so I think that's going to make the difference. If the dollar, if we start to see a short squeeze in the U.S. dollar, and we just continue to rally up on to my next targets without much of a pullback. Again, these targets here on a 60-minute chart. Then that's going to help the case to push gold down lower. If the dollar wants to make another run at that long-term support that I showed you a minute ago on the weekly, it can easily do so, and it will, if it happens anytime soon, guaranteed to be another bigger divergent low. So I'm open to these scenarios. You can wait for that. You may not get that. That's the thing. If you wait for that to go long the dollar or short gold, you may not get it. But if you do, you might get a better entry on gold. So it's not, bottom line, it's not an all-in aggressive short moment on gold, but it's, like I said, it's so far those sell signals are intact. It's just gone sideways. You just have to be patient on some trades. GDX, same thing. I told you recently, we hit T1. I give you 3 targets, just 3 near-term targets on GDX. We hit the first target. As with my price targets, upon the initial tag of each target, the odds for a bounce are likely. We got the bounce, back to resistance. And now we need to take out T1 to open the door to T2 and T3, which is down here. But now that trend line, when I first gave you T3, it was with price support about 42.67, and the uptrend line came in together. So what you're going to see now, and I may decide, we'll see. If this continues to play out, I may make this the final target down here, somewhere in there with that trend line right there. I just want to give you an update there. And again, you can see on GDX as well, big red candle. Not as big as gold so far, but remember, gold's been a crowded trade, and very crowded trade, one lopsided. And what that means in crowded trades and parabolic tops, blow-off tops, you tend to get a crowded rush for the exits. So that's it. So I think it's still worth having at least a partial, maybe a half position gold. Full position if you want. Again, I made that case too. Just like the stock market, the week we peaked back here on QQQ, SPY, and every other index, small, mid caps, large caps, they all put in the bearish engulfing candles back here. And the strategy I said was super simple and tremendous risk reward ratio. You put a stop above the high of the bearish engulfing candle, you short it, and because if it's taken out, that's no longer a topping stick. And that's the same thing I told you now. It's been, 2 weeks in gold? Same thing. So you can have a stop there, but that's why I do these long-winded videos. I want to point out you might want to give it a little bit more room, because I could easily see that, and they would give you that divergence. It could take a couple weeks to do it, next week or the following week if we get it, or not. So if you have a little dry powder, you could add it there. Here's USD and JPY, the dollar-yen pair. Big, it's a support zone right here we just bounced off of. We're coming up on downtrend line resistance, and then you have, we're below this longer-term yellow uptrend line. So if they take out the white downtrend line, we continue up to there. So I'm just showing you resistance levels likely to come in play on the dollar if you are factoring the dollar into your trading with gold or the euro. Euro, remember, when the dollar was bottoming, I showed you this is my longest term chart I can do on the euro. This is when it started trading back here in 08, and you have a nice clean downtrend line right there on the EUR USD pair. That's as far back on this charting platform as I can go here, and we hit that level recently. That's your primary downtrend line. It's a big level, and so far reversal there. You even had a little divergence. You can see I had it drawn on the indicators. I just somehow the line seemed to disappear right there. So that's it. So if this drops, again, the euro is by far the largest component of the dollar index at a 57.6% weighting, with the yen the second largest, and that's why I was saying it's. But everything's moving against the dollar today because, again, they see Powell. A couple things. I mean, you can't have your cake and eat it too. If the stock market's rallying, I'm just going with this hypothetically, okay? So for the bull case, the market's rallying, this breadth thrust indicator, the U.S. stock market, let's just assume we're going to go to new highs. How can you possibly go to new highs without anticipating a chance of zero or very low, almost no chance of a recession? So that's the thing. The market can't have its cake and eat it too. If the stock market wants to rally to new highs, it's going to imply a strong economy. Earnings are going to be good, hold up. GDP is going to hold up. Remember, we just had the first negative print of GDP in a long time. It's 2 consecutive quarters is the traditional definition. I'm guessing next quarter, it's going to be 3 months from now almost, we're going to have a second one, and then it'll be, NBER calls the official. They're the ones that get a call to recession, and they'll do it in hindsight. They always do. But Wall Street will pretty much agree that 2 consecutive quarters of contracting or negative GDP is a recession. So, what's it going to be? So we'll see. And again, all that's fundamental noise. Recession, no recession, it doesn't matter. At the end of the day, I trade the charts. I will factor fundamentals into my longer term outlook, but there's not a trader in the world, an active trader, swing trader, that can and does successfully trade off fundamentals. It's just too fluid, too dated by the time you get the information. By the time you read a 10Q, a quarterly earnings report, you try to follow Trump's Truth Social tweets or whatever you call them. You're driving in the rearview mirror. You're looking at old news. Usually by the time it hits, it's long since priced in. Or in the case of a quarterly earnings report, data that's up to 4 months old. It takes 3 months and a quarter, and then it's a full month before they actually report the information from then. And even then, they use whatever kind of accounting they want to, like a shell game, to move things around quarter to quarter. All right, guys, I'm going to stop here. That's it. So there it is. We still have, we're right pushing the high end of the bounce target zone on QQQ. Gold is, the dollar's starting to get some traction to the upside today. Nothing major, but one of its biggest days in a while. And now gold being down one of its biggest days. And then, it's a sister trade, if you will, to the shorts on QQQ, and that's the VIXY. We're still right there in the scale-in zone, the current scale-in zone. Let me look at that breakout. Yeah, I take that wedge breakout I showed you all the other day, and all this is right now, again, we really need to reverse here. Today's high in the market and in QQQ was the kiss of the 200-day moving average, the 200 simple. And so if, and that's a big if, but if it contains it and we're down tomorrow, then you should see this be a breakout and a successful backtest of that bullish falling wedge I gave you the other day. So, and that's also an objective short entry, just like I gave you an objective short entry in QQQ today earlier in that post I got out to you with the testing the 200-day moving average. There's when you have a bullish falling wedge and you're trading that, you have 2 objective entries. On the breakout, sometimes you break out and don't look back. There's always going to be counter trend moves, and quite often you break out and back test and then go on. So this is an objective short entry, and as would be, you could blindfold me and trade. You want to just trade the VIX, you just have to trade the indexes successfully. You're trading the VIX in reverse. The VIX goes up when the stock market falls, and vice versa. All right, guys, let me get it out to you. You know my thoughts. If you want updates on anything else, let me know. 30 minutes ago, I'm probably not going to do much more today. If I'm around, I'll do my best to answer any questions I see. Otherwise, I'll get back to it tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great day.